Hi, I'm Ben Reppond. Welcome to my YouTube broadcast. Today is December 21, 2022. We're going to cover the stock market and bond market and the direction that it's going and some historical data. I want to begin by saying in 2022, this was a challenging year, a challenging market for a lot of people because traditional portfolios, buy and hold, 60-40 stock and bond portfolios did not do well. I think a lot of people didn't expect that bonds would decline that much. I don't know why, because when interest rates are at zero, there's only one way to go, and that's up, which means there's only one way for bonds to go, and that's down. So it didn't surprise me, but I think it did surprise a lot of people. And the equity markets in the U.S. and abroad came down a lot. And the technology stocks, which were the darling from up to 2021, have been hammered, and many stocks, big name stocks, have come down 50% or more, some down 70% or more. And so it's from both sides, of both the bond side and the stock side. It's been a really challenging year. On the tactical side, even some tactical managers have had difficulty. I participate on a platform, and I see the performance of a lot of them that report from all areas, and generally it's pretty challenging. And it has not been perfect for us. We did really well in the first 6 months, even the first 9 pretty well. And then the fourth quarter was our challenge. Others have struggled in the first part of the year. But what we've done about that is we've made some adjustments. We've tightened up the downside protection. And so we're prepared for 2023 if it's a negative market, which I think it probably will be. Okay, so let's get into the dashboard. This shows the major indexes, the Dow, starting from the least worst, Dow, developed countries, S&P 500, Russell 2000 small cap index, emerging markets, and 20-year government long-term bonds, and the NASDAQ 100. So those, in descending order, those are the, from a year-to-date standpoint, those are the performance of the indexes. The ones who did least worst are at the top. The least worst is the Dow, which is down about 9% for the year, and then followed by developed markets, S&P 500, Russell 2000 small cap index, emerging markets, long-term government bonds, and NASDAQ 100. So all of them, except for the bonds, were negative or below their 20-day moving average. And some of them are below all averages, 20, 50, 100, and 200. And those are marked by a red dot on the right. So going from left to right on the dots, that's the 20, 50, 100, and 200. And if they're above the moving average, that shows some strength, and they are represented by a green dot. When we break apart the S&P 500, there are 11 sectors, and the sectors are from every area of the economy. So at the top, energy is very positive, but for the week it was positive, but for the month it has been quite negative, and so it's still below its 20 and 50-day moving average. So when something goes as high as it did, I would expect a correction down, and that's what's happened. But energy does its own thing. It goes up and down, sometimes just completely disconnected from the rest of the broader market. And you can see, just like in the previous slide, you can see the 20-day moving average, that going down that first column of red dots, every single sector, even including energy, are all below their 20-day moving average. And then next you get to the 50-day, it's mixed, 100-day moving average, and even the 200-day is mostly negative. So on the dots, I keep track of this, there are 15 green dots compared to 24 last week. So the number of green dots usually indicates the general direction of the market. And for the past week, that was negative. This is the, switching over to the charts, this is the weekly chart for a 12-month period for the S&P 500, and it is down for the week and down for the last couple of weeks, as you can see at the end, indicated by a downward direction of the equity line. The black arrow that I put through the data shows the general direction is a declining direction for the S&P 500 over the past year. When I take the S&P 500 and break it apart into two kinds of stocks, growth stocks and value stocks, and then plot that ratio on a chart, its numerator is growth and denominator is value. So if the line is moving up, that's indicating that growth is stronger on a relative basis, stronger than value, and vice versa. So you can see over the past year that the growth has been out of favor and continues to be out of favor, even it represented at the far lower, excuse me, the far lower right of the chart. So value continues to be in favor. We saw that also on the data in those dashboards. The top performer, or the least worst, was the Dow, and the Dow is the 30 industrials, which tend to be value companies, and that's the least worst index for the year. So that's represented by, this chart is an indication of that data. Okay, this chart is the ratio, again, relative performance of showing what is stronger, the small cap index, or represented by IWM, the ETF IWM, which is the Russell 2000 small cap index, compared to SPY, which is the ETF for the S&P 500, large cap stocks. So when it rises, that favors small cap. The IWM's a numerator. When it declines, that favors the S&P 500 or large companies, large cap stocks, and that's, so you can see that the, relatively speaking, small cap continues to stay out of favor. Government bonds, long-term government bond. So you can see a couple of periods at the initial, on the left side, period where the 20-year government bond, long-term government bond declined, the ETF TLT, and this is a 30-month chart. And then that last period of decline, it has continued to decline. But at the end, you can see it has begun to move up. So we saw a week where the long-term government bond basically had some strength to it in a declining equity market. So we don't know if this is the beginning of a trend yet, but it certainly is positive for the price of bonds, which means that the yield probably went down. Okay, the dollar went for a period of time, an 18-month chart, so the dollar went for a period of time for, over a year, where the dollar was just strong, strong, strong. But then recently, you can see from the black arrow at the end, the US dollar has now begun a decline. So it's weakening. It's still very strong against other currencies, but less so than it was several weeks ago. Gold. Gold has been moving up, and you can see that, but this week was it took a breather this last week and declined slightly, but is still, because it's above that moving average, in my opinion, is still showing some strength. And silver even more so. Silver has moved up, but again, took a breather this past week, and you can see that from at the very end of the chart, it went down slightly. When we compare silver numerator to gold denominator on a relative strength basis, when this moves up, it favors silver. When it moves down, it favors gold. Which one of the two of them, which one is stronger? It's all just showing relative performance. So you can see the direction on a comparison basis that silver has maintained a stronger, has gone up stronger than gold has. Bitcoin continues to decline. This is a 13-month chart showing the weekly movement. One move equals 1 week. And Bitcoin has continued to decline. It's this drop, this is a 13-month drop. That drop is about 85%. That's just Bitcoin. There's other cryptocurrencies, but that's not Sam Bankman-Fried or FTX. This is Bitcoin. And still does not look like it is much in demand. So we'll see where this goes. Okay, this chart is on the volatility index, and it is the VIX, VIX, and it shows that if it goes up and down a lot, and when it is below, typically when it is below that arbitrary black line I put there, it generally shows the market has a positive element to it. Even though I've shown you a lot of data that showed this past week was negative, from a volatility standpoint, it was not as negative. So I think that's interesting. Sometimes that happens. So it actually went down a little bit this week, which was a positive indicator. But that's where it's at, a little between 22 and 23. Asbury Research does charts, data, and their chart as of Friday showed that all 6 of their indicators were negative. And that's not surprising given the data that I just showed you. On a cross-asset relative performance, this compares asset to asset, showing which one is stronger. Now, it doesn't mean it's strong. In some cases, in some of these cases, it means it's less weak. So, for example, in bonds and stocks, both weak. We've already covered that, but bonds are less weak than stocks. Low volatility is better than high volatility. Blue chip stocks, let's say the Dow Industrials, for example, considered blue chip stocks, are better than the NASDAQ 100 and better than the S&P 500. And so, and that's no surprise given the data that I've shown you. The broad market is better than the NASDAQ 100. The NASDAQ 100, we've shown a lot of data on that, growth stocks, and the index itself, quite weak. The broad market represented by the S&P 500, which includes both growth and value stocks. And then value stocks, of course, are better than growth stocks. What I thought was interesting was that the foreign markets are better, generally speaking, most of them, than the U.S. market. Both developed and emerging markets have been doing better in the last week, the last month, and the last quarter. And finally, corporate in the bond area at the bottom, corporate bonds are less weak than government bonds. So the next chart is the U.S. versus the world. So the 3 columns to the right are the last week, the last month, the last quarter. So how has the U.S. market, just represented by SPY, the S&P 500 ETF, how has that done against the ETFs for all of these countries? Again, representing those markets in general. And can you see a single box that indicates that the U.S. in any of these time periods is better, stronger than a single other country? Isn't that interesting? And these are not their economies, these are their markets, stock markets. I take the ETF, EFA, which represents developed markets, which is primarily Europe and Japan, South Korea, probably Australia and Canada, developed markets, but it's heavily Europe and Japan. And you can see the when the S&P 500 is stronger, it's the numerator. When it's stronger, it's going up. When it's going down, that indicates that Europe, Japan in general are stronger. So you can see the degree to which the U.S. in these short periods of time is weaker. The markets, not the economies, but the markets are weaker than these developed countries. Then over to gold and silver. As I've shown you in the previous chart, that gold had a little bit of a pause or slight downtick for the week. It's been going up generally, but it took a week off. So same thing with silver, down slightly from its high, but has been generally going up pretty rapidly. I don't see that there's weakness in these, so I don't see this as the beginning of a downtrend. I could be wrong, but that's my take, is that it was more of a pause. Well, thank you for watching. Enjoy the Christmas week. Have a happy holiday season, and I will see you next week.